Hi, this is Sebastian and welcome to the Fire Belgium show. In this episode, we have a fascinating interview with Corentin Scavee, who is the co-founder and head of customer satisfaction at Easyvest. Easvest is one of the first automated investment services in Belgium. In this interview, we cover a lot of ground. We talk about how Easyvest investment philosophy is very different from most other options in Belgium, how index investing compares to active management, and how it consistently provides better returns for the investors. We dive into many aspects of investing with Easyvest: their portfolios, risk management, asset allocation. We talk about taxes, fees, and the role of bonds, among other things. We talk about the pension plans that are available to self-employed and company owners and all their tax advantages. We speak about how Corentin and his team are running Easyvest, their structure, their challenges, and their goals. And we also had great questions from the audience. It's a pretty long interview, almost 2 hours. And so to make it easier for you, we've provided a table of content of this interview in the description below, and you can select exactly the section you want to watch so that you can focus on what you need most. Before you get started, there's something I wanted to clarify. Whether you decide to go for DIY index investing, like the method I teach, or whether you decide to go with an automated investment service like Easyvest, what's really important is that you start investing using the simple and effective approach of index investing, using trackers, low cost, broadly diversified ETFs, and stop wasting your money on actively managed funds that are often too expensive and poorly managed. They basically, over the long run, never do better than the index. And so here is not a matter of deciding putting DIY investing versus automated investing in the, as long as we are in the index investing world, your money will be well taken care of. So without further ado, let's start with the interview. Corentin, thank you for joining us today. So everyone, Corentin is the founder of Easyvest and also the head of customer satisfaction, which I think is the most important role in most companies. and Corentin has a background in finance and private equity, and he's gonna tell us more about that very soon. But he's basically here today to tell us more about how Easyvest works, how Easyvest can help you invest in a simple and effective way for your pension, and basically we're gonna go in depth in some of those questions around the philosophy of index investing, some of the technical aspects of that. But also we'll talk about pension plans and what role they can play in someone's personal finance, especially for self-employed people, I believe. So with that, Corentin, welcome. Like a big thank you for being here and taking the time. I know that you have family and a lot of work to do, and so it's really like an honor, a privilege to have you here, and I hope everyone enjoys this conversation. Thanks a lot. Right, so maybe we start. Like I obviously you've seen I have a set of questions, lots of questions, but we'll try to get through the most interesting ones. But I would like to hear from you a bit about your background and where you come from and what led you to start Easyvest.
Okay, so as you said, I'm an entrepreneur. I'm 37. I'm married and the father of 2 kids. I have a little daughter who is one month old now. I was born and raised in Belgium, and I studied in Brussels, and after that at the university in Louvain. I'm a business engineer with a master in market finance. But after university, I did what many people do. I joined consulting at Roland Berger. That was kind of another master where I learned a lot of things, but that was far away from financial markets. But I learned a lot of good skills there. Before going back to financial markets, I worked, as you mentioned, in private equity, working on the financing of renewable energy projects, large-scale projects. And then I joined a family office in Brussels, and that was linked to an asset management structure in Luxembourg. And there I managed the family office, and also I co-managed a hedge fund during 5 years. So I have a background that is at the opposite of what I will be talking about today, so index investing. But it gives me, I have a very interesting point of view because I did the evil, and so active trading, stock picking and everything. So I can talk about that, and I can talk about how it works or why it doesn't work. And I have a real experience. So that's basically my background. And after 5 years at the family office, or actually already in parallel during the last 2 years, I founded Easyvest with a business partner. So Mathieu Remy, my business partner, who was actually, when we started, he just came back from the US from his MBA at Harvard, and he had seen the emergence of robo-advisor in the US, and he wanted to bring that to Europe. So that's basically it for me.
Wow, so obviously the obvious question that comes to mind is, what led you to go from doing, active asset management and wealth management to starting something that's at the opposite, like passive investing?
There was some kind of frustration in my job, but also in the money, the way my family's money was managed. The whole industry is based on stock picking in active management, or at least in Europe, most of the industry still is. It's changing. It has already changed in the US, but here I was really frustrated. I was in my job trying to chase the markets, trying to beat the markets, and I was seeing it doesn't work, or when it works, it's only luck. And I was seeing that in Belgium and in Europe, actually, all the investors were getting poor performance. They were charged high fees. The managers would charge the fees whether they had good or poor performance. And they also had no tools, digital tools to plan their future, financial future. People were selling them investment products based on past performance, and never talking about perspectives and planning, and never trying to reduce costs. So since I was disappointed about active investing, I came naturally to index investing. And if you believe that you cannot beat the market, the next thing you should do is try to reduce the cost of investing. So that's what we try to achieve at Easyvest.
Yeah, obviously we're jumping in straight into the next topic, but yeah, it's amazing that people like you exist, because it's difficult, I think, to move away from one religion to another religion, essentially, right? Believing stock picking and making money that way, to moving away from that and taking risk to maybe not succeed in a very new industry that's that has a lot of challenges ahead, right? So thanks for doing what you do. This is completely aligned with what we do in FIRE Belgium and Financial Independence Belgium. And so, yeah, thanks for the work you do, because we need more people like you for sure. And hopefully we can find ways of convincing all the stock pickers and active managers to see the light like you did, and, and move in this direction, serve the investors in a better way, right? So thanks for doing that. So Corentin, why did you start Easyvest is, the obvious question, but like, what drove you to do what you do now, as opposed to, so there was disappointment, but from being disappointed to actually starting a company to try to fix the problem, like there's a big jump. So what drove you to start this company?
Well, that's something personal. As I said when I started, I'm an entrepreneur, so I always looked for an entrepreneurial project. I was just looking for an opportunity to start my own business. I was already an entrepreneur at the family office because I was working as self-employed with a company, management company. But that was not my company. I was working for somebody else, and I was looking for the right project, the right partner to start something. And when my friend came with that project of starting a robo-advisor in Europe, in a field where I had skills, with a project I believed in terms of investment approach, but also in terms of success, because I believe that it's just a question of time and talking more about index investing before it gets really big. I came naturally, came naturally to the conclusion that I had to jump in. So
yeah, and I've thought about it many times, but I don't think I have the skills like you do. So I'm glad you're doing it, because we need to change this. And so, who is your target market with Easyvest? Is it the same as your previous clients, or is it a different market?
Well, actually, I think that what we offer at Easyvest is suited for everyone from 5,000 euros to 5 million euros. It's true that people who have more than 1 million usually seek other kind of services or follow-up, but the investment solution that we promote are the best for all those people. If you have more than 5 million euros, maybe you can have access to other asset classes where you lock money for a longer period and you can capture illiquidity premiums. But for all those people who have less than 5 million, what we offer is the best option. We started by targeting the millennials, but what we see when we run analysis of our customer base is that there is no single age bracket that is standing out. So we have millennials, we have people who are have just reached majority. We have kids who are 1 month old, like my daughter.
Really? Okay.
Yeah, you have to start as early as possible. I come back on that. But from all the clients that we have, there is just we don't see that the millennials are more into our product than other people. We see that we have a gender issue, so we have less women, about 20-25%, and many of them actually have a joint account with their husband. So it's something that we don't desire, but we see that in our customer base. But for the rest, we target everyone that is interested in index investing or who is looking for a performance investment portfolio that is easy to understand and easy to follow.
Yeah, it's true that there's not so many. I mean, it's majority of men as well in the financial independence movement in general, and hopefully that's something that will change over time. I am trying to do my part by interviewing women in the financial space, and so that I can hopefully inspire more women to get into this. So one way of doing that maybe is to bring more women on the show, or maybe in your team. Anyway, joking aside, so why should people invest with Easyvest as opposed to, say, traditional banks?
Well, just because you should join Easvest if you want to build a high-performance portfolio and you don't know how to start, and you want to have a professional that helps you put the things in perspective. So we are not like most robo-advisor or digital solution where you set up everything online. There is always a human interaction that helps you put things in perspective, answer your questions, and make sure that the portfolio that has been recommended is suited for you and your project, and answers your question in the future. So if you're looking for something low cost, I don't like this, but that doesn't cost much, that is performance, and where you have a bit of service, then we have the best solution. If you compare our solutions to retail banks, of course, you don't have a lot of fees that they charge you don't have with us. So no entry fees, no exit fee, and our fees are between 3 and 6 times lower than what they charge. So that's a big reason to come and join us.
Yeah, so there's obviously the fee aspect, and then there's the investment philosophy aspect, right? So let's talk about the fees aspect. Like, how much does it cost for someone starting with Easvest?
It's between 1.5%, depending on the amount you invest. So if you start with 5,000 euros, it's 1%, all inclusive. And if you invest more than 250,000 euros, it's 0.5%. And it's decreasing based on the value of your investment.
So
Yeah.
someone starting with 5,000 would then get charged 1%, so that's 50 euros a year, for example,
Yes.
for help in setting up their portfolio, advice in managing taxes, optimizing risk, their risk profile and the portfolio according to that. So that's a lot of work for 50 euros. That's pretty good deal from my perspective.
Yeah, we believe it too, but but people, it's actually, we have run a survey. Cost is important. What people value most is performance.
Yeah.
And simplicity. Actually, that's what they like with Easyvest. Low cost is just, or performance is a consequence of low cost, but they don't focus on low cost, which is a bit weird. But it's based on, in the world in general, except in finance. If you pay more, actually, very often you get more, and people tend to believe it's the same in finance. If you with Easyvest, you save money, so you get more performance, and that's the way we try to bring the highest performance to our clients.
Yeah.
But as you say, there is a lot of service. It's not fully automated. There is a lot of follow-up of our clients, and actually 50 euros is not much for that.
Yeah, indeed. So definitely a great way for people who just want to get started. I think this is probably the best way to do this efficiently without making too many mistakes and actually getting the money to work hard for them rapidly, right? So that's pretty impressive. And this 1% down to 0.5%, does it include everything, or is that your management fees and then there's more costs on the side?
There is nothing for transactions, depository, there is no VAT on top. The only thing is the cost of the index funds, which we have. Well, we are transparent, so they charge their fees on top. But actually, if you run an analysis, you see that the trackers deliver the performance of the index, whatever their cost. So it's true, they charge something or they get paid, but you get what you ask for, so the performance of the index. So it's, to my mind, it's neglectable.
Yeah, and it's very small, right? Is it around 0.2% or 0.3%?
It's but the index is very broad, so depending on the exoticity or the broadness of the index, then you might pay more. And here it's an index with there are 9,000 companies in it, so it's 1.4%. But as I say, if you run an analysis over a period of 10 years, you will see that the difference of the performance of the index compared to the tracker is 0.3%. So it's nothing over 10 years. So
interesting. So it's a specific index that charges a bit more than the usual low-cost ETF. But they perform.
10 years,
But they perform as well as just the index they're tracking.
Yes. Exactly.
All right. Can you share with us like what fund these are, or what series of funds, like the providers, etc.? Is that something you could share?
Well, we work with State Street, but most funds actually most fund providers try to achieve that performance. The performance of their fund is measured based on what we call the tracking error, so the difference between the performance of the index and the performance of the fund. And the lower the tracker error, the higher the best the manager, the better the manager. And if they want to attract institutional investors with a lot of money, they have to bring that tracking error to the lowest level as possible. So most BlackRock, State Street, or Vanguard achieve that. Also because they get money from other sources, so lending stocks or things that they can do with the portfolio, or optimization of the portfolio based on correlation models. So I cannot really point to one fund. I think that's general in the industry.
Yeah.
Actually, I talked with all funds for a certain period was actually performing better than the index over a period of 5 years. I think it wasn't the case last year, but between 2016 and 2018, you would get a better performance with the index. So you had almost a negative fee structure.
Yeah.
Because that's something technical about index funds, but they don't replicate perfectly the performance of the index. They have to build a portfolio that will deliver the performance that is the closest to the index. And there are some ways to optimize that, and sometimes to get the better performance, and they manage to achieve that.
All right. And so just to come back to the cost of, so the total expense ratio of the funds you're using, I understood 1.4%, or were you saying 0.14%?
It's 0.1, 0.4%.
0.4, okay.
That's for the stock index, and for the bond index, usually bond trackers charge much less. And here it's 0.15%, so almost nothing.
Yeah, and in the end, as you said, cost doesn't matter. If the index fund is able to track the index or do better, then it's virtually no cost or negative cost, as you were saying. So that's an interesting perspective, because we, in the financial independence community, we often focus on costs, which I believe is a bit of a mistake if we go too far into that direction. And this is another example of that. So either, one way of focusing on cost too far is to go to the cheapest provider of a trading platform, which might not be the most reliable. And then another way might be to go to maybe the cheapest of the ETFs that might not be tracking the index properly, whereas a more expensive one might be better at tracking and maybe overperforming the index. So that's another interesting piece of information that I think the community will appreciate. So thanks for that. So we talked about index investing. What's your philosophy of investing? How would you summarize your investing philosophy in just a few words or a few sentences, I guess?
Just a few words is just we believe that nobody beats the market. That's it. That's our main statement. When we start a presentation, that's our first slide. So nobody beats the market. You can try as much or as hard as you want, you will not manage to do that. And that's what created so much frustration with me when I was an active manager. So you can try, you will waste a lot of time and a lot of energy and probably a lot of money trying to beat the market before you realize it's not possible. So forget about stock picking, forget about market timing. You might be lucky once. I hope you will not be lucky the first time, because it's like casino. If you get luck once, you want to play again. You should just, as we do, you should just buy the whole market. All stocks that are available to investors around the world, you just invest in all those stocks. In the past, it was very difficult for parents because they have access only to stocks on the Belgian market, maybe Paris, sometimes with some brokers to do some US stocks. But today, with the funds and index funds, it's really easy actually to buy all the stocks around the world. And once you have done that, what you should do is hold them as long as possible and try to minimize your taxes and your costs. How we do that? Well, we invest in trackers, and to minimize our tax, we choose the right trackers. So we have selected capitalization trackers, and we rebalance the portfolio only when it's really required. So we don't try to time the markets. Actually, when there is an imbalance, when the portfolio is not balanced anymore, it means that an asset class has been going up much more than the other during a certain period of time. And if you rebalance at that moment, usually it matches the moment when the market has reached a high level. And then you will sell stocks to rebuy bonds. And if the market goes down, you will do the opposite. And that's actually, you will go along with the market, and you will always be aligned to your risk profile. So you will never face losses that exceed what you can, the risk you can take. And you will actually buy more when the market goes down. So basically, in a few words, no one beats the market, and in a few sentences, just what I said.
Well, thanks for that. I mean, exactly aligned with what we do here. So we love to hear that from you with your perspective. And yeah, I was wondering, are there specific pieces of evidence that you use to convince people around you in your industry or your clients that, you know, nobody beats the market? Is because it's a big statement, and obviously most of the financial media doesn't agree with it because otherwise they would have no business. So how do you convince people that that's really the case?
Well, we run analysis that have been run before in the US or in other markets. So we compare the performance of our world index with the performance of fund managers that were listed on Morningstar in Belgium. There were like 40, there were 80 global funds, and we took only those that had a long track record, because you cannot really say that somebody is successful after 3 years, even 5 years. So we took only those that were there for the last 10 years, and that had been through actually a crisis, so 2008. And we ran an analysis and compare the performance with the performance of the index every single year. And it was just statistics. So we saw that after 1 year, every given year, only 37% of those professional investors, active managers, were beating the market. So it's less than half. That's after 1 year. So it means that you pay a lot of fees to those people just to beat the market, and there is less than 50% chance that you will actually get a better performance. They do that for a living, but they don't manage to beat the market. Yeah?
That's over 1 year.
Yeah, over 2 years, it's only 15%. Over 3 years, it's only 7% of them that beat the market. Over 5 years, it's only 1% of those funds that manage to beat the market 5 years in a row. And after 5 years, there is no one beating the market. So it's statistics. You can run the analysis. It's partly due to costs, partly due to bad decisions. It shows that statistically they are actually less good than the market because of cost, but also over time they will make mistakes. Over a short period of time, you can always be lucky. But my experience is that it's just pure luck. So you cannot, even after 5 years, it's just tossing coins. If you do that 100 times, you will get the same sides 5 times in a row if you do that 100 times. So, but it doesn't mean that you have some skill to be able to do it. So we have that analysis, and then people say, yeah, but there are some managers that are better, that are known for beating the market. And many say, yeah, look at Warren Buffett. Actually, is kind of running a fund with Berkshire Hathaway and has been beating the market. And there as well, we have a slide in our presentation where we compare the performance of the S&P 500 total return, because you have to take the total return, including dividends and everything, to grasp the whole performance of the index. And we compared that since 2002 with the performance of Berkshire Hathaway. And you see that he's not beating the market anymore. The S&P is the best proxy of Berkshire Hathaway because they invest only in the US. And since 2002, you would have done better investing in an index fund following the S&P than investing in Berkshire Hathaway. There are many reasons for that. It's because first he had luck during the tech bubble. He was not investing in techs. That was one thing. And the second thing is, before that, it was a period where there was a lot of information asymmetry on the market. So it was possible for some investors to have more information than other investors and to beat the market. But today it's not possible. So there is no one on the market that can have more information than the other and use that information to get a better performance. So today it's basically the best performance you can get over a long period of time is by investing in index funds. Okay.
Thank you.
I hope that's convincing enough.
Yeah, that's brilliant. And I'm going to have to look for those. I'd be interested to see the analysis because this is information I'd like to share with the community. So we'll talk about this afterwards.
Well, you will find a blog in the blog
seen...
section of our website. There is an article on that.
Okay, brilliant. Thanks. So what portfolios do you offer? And how do you build portfolios for your clients?
So portfolios that we offer, there's just basically we offer portfolios that are built using trackers, and we build portfolios that are fairly simple. So we just have two asset classes. We have the stocks and the bonds. No corporate bonds, only state bonds. And that's our asset allocation. So if you build a financial model, a financial optimization model, and you put all the assets or the trackers or the index in the world into that model, the model will always select two assets. If you want to have more assets, it's not going to be optimal. So if you want to have more than two assets, you have to constrain the model to add more asset classes. And the solution is always the same in the optimization model. It's going to be a stock portfolio for the risky side of your portfolio, and a corporate bond portfolio for the safe side of your portfolio. And based on the risk profile that you want to take, technically it's called, we will use the value at risk as a measure based on your value at risk. So how much loss you can bear over a certain period of time. Then we can select the right weight of those two asset classes.
You said corporate bonds, right? Not government bonds?
No, I meant government bonds.
Okay, yeah, that's what you said earlier.
Yeah, we don't use corporate bonds for a simple reason. Is corporate bonds are correlated to stock market. So if the stock market drop, the risk of the companies will increase, and the value of the bonds, or the risk of the bonds will increase, and the value of the bonds will decrease. So you see a high correlation between corporate bonds and market drops, whereas government bonds are used as a safe haven where people invest when they don't feel comfortable investing in other asset classes. That was mostly strongly the case in 2007, where people were not trusting anybody, no financial institution. They were trusting only states. So they invested massively in government bonds because they prefer to hold securities than having money on a bank account with an institution that could go bankrupt the next day. So you see really inverse correlation between those two asset classes. So when the market drops, the government bonds will go up, and that was again the case this year. So it helps protect you against downside.
So I have a couple of questions on bonds. Do you have a preference in terms of duration or maturity of the bonds? Short term, medium term, long term? What do you use?
Well, today you don't get. We use the tracker we invest in is a blend, so it goes up to 40 years. The average maturity is around 8 years. You have short-term maturity, but today, if you want to get the role of a bond is to protect you against the downside risk. In the past, it was yielding something. Today, it's not yielding much anymore, but it's not really its role anymore. It's just to protect you. But still, you don't want to have negative performance, so you do have to seek a long duration. I would prefer to have a long duration with a state bond than a short duration with a high yield bond that is very risky and correlated to the market.
Okay. And so you mentioned the current returns on bonds at the moment. So basically, the interest rates are very low.
Yeah.
And so that combined with the fact that we have to pay some taxes on bond gains, whether they're distributed or they're capital gains, at least via ETFs, there's a tax to pay no matter what we do. Despite those two things, you'd still see a bond, you still see a role for a bond in a portfolio?
Well, the tax will not be very high because the interest rate will be low, so the performance will remain low. As I said, the role is to protect you against downside risk. That's why I would have bonds in your portfolio. We don't really favor portfolios with more than 50% bonds at Easyvest unless you have a very short-term investment horizon. But we will talk about pension plans later. There, for instance, I see a role for bonds, but not when you start investing. I don't feel that because it's the bonds are not yielding anything, you should just invest everything in stocks, because then you will be taking too much risk. And still, we have a very positive return. This year, for instance, the return on bonds is still 2.5%. So it remained interesting.
Yeah, and I'm asking the question because in the community we have a lot of people who are, new to this, I would say, and they obviously overanalyze and overread, and they realize that bonds, for some reason there's some advice that goes around saying bonds, the performance of bonds is likely to go down in the future because interest rates are going to go up, and when that happens, bonds tend to go down. Plus, you have to pay this and that taxes, and so there are quite a few people in the community that are investing 100% stocks, and I agree with you. It's very risky, especially that most of these people are people who have not gone through a crisis, and they either don't have very much assets in their portfolio, and so obviously, or it's not, it's if something happens, they're not losing very much, but once the portfolio grows, it might be a very different story. If they go through a crisis, it would be a very it's a different story as well. And then, you mentioned rebalancing earlier, and I think
exactly,
they forget the power of rebalancing and the fact that an optimal portfolio from a risk-adjusted return actually needs bonds to be more performant over the long term. This is something that we've discussed in the previous interview, but basically we had this efficient frontier analysis that was showing that 100% stocks was actually less performant than, I think it was 15% bonds and 85% stocks. But basically more arguments in favor of bonds. So I agree with you, and I'm glad that that's what you're suggesting to your clients, because it's super important, and it's something the community needs to hear more about, why bonds are important and why they're necessary. And so that's why I was asking the question.
But you still have a positive return on those on bonds, at least with Easyvest. But it's true that for that you have to be exposed to long maturity.
Okay.
But that's not a big issue.
All right.
You were in the series of questions you sent me. You asked also about other asset classes like gold.
Yes.
And
yes.
You mentioned other fixed income. I don't know what you mentioned by that. I'm not very fond of gold because it doesn't yield anything, because it's very irrational. But people say that it protects against inflation, and when there is inflation fears, people invest in gold, and it tends to be, I would not say inversely uncorrelated. It's uncorrelated to financial markets in some ways. But still, I think that over a very long period, it has been doing less good than bonds. So I don't see why you should invest in gold instead of bonds. I would favor bonds.
I see. Yeah, and I think, especially because the analysis that you mentioned earlier, that building an optimal portfolio always came up with two asset classes as opposed to a third one, say adding gold to that. Maybe there is no direct benefit to adding gold to those two main asset classes. Now, my understanding was that because gold was poorly correlated or uncorrelated to financial markets, that it could act as an additional diversification, basically another opportunity for rebalancing when things are moving. Right. but it's something that I have to confirm somewhere because that's sort of my intuition and what I've read in different books, but I'm not sure how it works right now for real anyway. But yeah, so gold is something I'm interested in, and then other fixed income asset types. I was thinking just cash deposits, right? Because there is this guarantee on savings account for Belgian savers and then obviously the interest rates are extremely low, so it makes almost no sense to keep it in the savings account. But some people are worried that some people basically use savings account as opposed to bonds for the stable part of the portfolio. What do you think about that? Obviously I'm not sure that's something you would offer because it's not an asset that is part of a portfolio, but what do you think of a client suggesting to go with that? So say a client wants to say, well, I want to go 100% with Easyvest because I have my savings in this, bank account there for my, like, the stable part of my portfolio.
Well, it's very stable, but meaning it doesn't go up either. So,
yeah.
With bonds, you still have the possibility that you will have a positive return. And we have clients with a portfolio that with a very low risk, and you would be surprised how well they perform this year. So I think that, saving accounts is never a good solution. And when the money is it's easier to sell bonds and then buy stocks and do a quick rebalancing when the money is on your investment account than when the money is on your current account. You think twice before moving the cash to your portfolio, but when it's already in the portfolio, you make a quicker decision because it's already there and it's already exposed.
Yeah, and it's part of the strategy of the portfolio, right? Because obviously rebalancing will happen when stocks go down. It's hard. I mean, some people have the discipline to say, well, stocks are cheap now, I'm going to buy more of them and rebalance with my cash account. But there's more barriers to actually doing it because it's not natural. It's not part of the portfolio. Also, there's a risk that people are going to look at the portfolio, only the stocks, and actually forget that they have all this, the savings as part of the portfolio. And so instead of making a 30% loss, they're just making a 15 or 20% loss. And so there's a bunch of things that are more psychological, I think.
That's true.
Which could hurt. And but I mean, I know people who are doing that, and best of luck to them. But they know the risk because we talked about it. So hopefully that'll be fine. We talked about taxes very briefly. I was wondering how that works for you in terms of running, clients' portfolios. How are taxes handled?
So in Belgium, it's not really possible to do tax harvesting as it is in the US. So in some countries, it's possible to optimize tax much better than in Europe, because actually all capital gain are included in the tax declaration at the end of the year. So we don't have that in Belgium, but it's a good thing because we just are not taxed on capital gains. But there are other ways to optimize taxes. Taxes is a cost like any other cost. First, you can just optimize costs by selecting the right financial instruments, selecting the right ETFs, or just selecting ETFs because they are charged less than others. And also they give you an exposition to a very broad portfolio, so you don't have to constantly sell one stock to buy another one because you believe that Tesla has gone up too much and then you want to buy another stock that is undervalued. And every time you pay a tax, if you are invested in a tracker, you pay the transaction tax once, and then you just kind of not forget your portfolio, but you just rebalance sometimes, and you expose to the transaction tax only on the marginal part of your portfolio. So that's one way, selecting the right instruments and having an instrument that is already diversified so that you don't have to trade all the time. The second thing is that through pension plans, we offer tax deduction, so you can invest your money as a self-employed or as a company manager without paying taxes. So you will save up to 50% on what you will invest, which is great. The problem, the thing that goes with that is that that money is blocked until you retire. So it's a good thing because we will talk about it later. Pension planning is a long-term game, and since you are forced to leave that money on the side, actually you will play that game until the end. So that's the two things we do. We select the right financial instruments, and we wrap those financial instruments in tax deductible products.
Okay, yeah, we're gonna come to that in a few minutes. I wanted to ask you. You did mention that you select the asset allocation of your clients based on the risk they're willing to take or that they can handle over a period of time. Can you tell us more about the process of assessing risk tolerance for clients, and from there, obviously, the asset allocation?
Yeah, well, the right asset allocation is based on, we ask our clients a few things. So first, the investment goal. Depending on the goal, we will have a different approach in terms of risk. We ask the investment horizon. Sometimes that will just be linked to the goal. The age of the person, that can have an impact on the risk that you can take. The size of the wealth of the person compared to the investment he wants to do with us. The more you invest compared to your whole wealth, the less risk you can take, but the more important it is to choose the risk wisely. And then we will ask about the risk appetite. So how much somebody can dare to lose over a given period of time without panicking. And the combination of all those factors will give the right asset allocation. So for instance, I'll just give you an example. If you're 30 and you're saving for your pension, then you should take a lot of risk because your investment horizon is very long. You're probably a risk taker because you are young. If you save for pension, you would probably save also regularly. So you are investing over time, which is another reason to take risk. And so for people who are young and start a pension plan, we usually recommend to take almost 100% stocks. But if you want to, for instance, you have some money or you want to save money to buy a house within 5 years, there it's very different because you have a specific goal that is a very short term. The money that you have, you don't want to lose it because you have to use it to buy your house. So you will start with probably a neutral portfolio, and then over time you should decrease the risk of your portfolio until you get to that moment when you will use the money to buy your real estate property. So those are two scenarios where we assess the risk, and there is also some dynamicity in the risk, the evolution of the risk over time.
So I have a surprise question for you, if you don't mind. So as you know, our group is all about financial independence, which is, for some people that means early retirement. So here's another scenario, which is probably, quite uncommon, but some people in the community will fit this scenario. So that's why I'm asking. Imagine there's someone who's 30 or 35 and coming to you and saying, "Hey, I'm saving a lot of money and I want to invest with Easyvest. My plan is to save as much as I can, invest it wisely, and retire in, say, 8 years." So whatever that person age is. So it's 8 years later. So instead of investing for pension, it's a pension too, but it's a pension that has to start much earlier and last much longer. How do you handle that from an asset allocation perspective? Let's imagine that person is investing everything they have with you, right? So there's no other income, and it's like, so you have all the information basically. And that person is, they're okay with risk. They're really okay with risk.
Well, if they're okay with risk, I will just stick to what I said for the person who is 30. So if you want to build a wealth as quickly as that, and 8 years is already actually a long-term investment horizon, then you should go all in with your investments, and then you should save as much as you can until you you want to retire, and then maybe you should decrease slightly the risk and take something like yeah, probably a portfolio. We have 10 different levels. It would be a portfolio 7 after retirement, or 8 with 20% bonds and the rest, or 30% bonds and the rest in stocks. It doesn't really matter if the market drops just before you want to stop working, because you should remain fully invested. That can happen just before you want to retire or just after, but whenever it happens, well, first it happens all the time, and second, it will recover straight afterwards. So it doesn't really matter. That's my recommendation. We have a tool actually where you can plan for retirement and you can change the pension age. So if you are 30 or 35 and you want to stop at 40 or 45, you can just change retirement age, and then we will tell you how much you should save based on the target income that you would like to have after retiring or stop with working.
Okay, we will link to that tool and calculator. I think that's quite interesting. Very cool. Well, thanks for that. Thanks for answering the surprise question. That was very useful. So let's talk about pension plans. This is something that when we prepared for this interview, you told me that very few people actually offer those plans the way you do. So I'd like to hear from you. Just what is it that you offer, who they are for, and then why is your offer different from traditional pension plan providers?
So basically, the pension plans. Well, you can do pension planning without fiscal tax advantage, but here we are going to focus on those products that will give you a tax advantage, and basically you have to be self-employed or self-employed with a management company.
The main condition is being self-employed, because employed people don't have access to those specific plans. They have access to the épargne pension, which is a separate thing, right? Which brings a very small tax advantage, but maybe cancelled by the fees of the plan himself. But so we're not talking about that. We're talking about the plan specifically for self-employed.
Yeah. So if you're self-employed and if you want to save money, there are two options. One we don't really like, and it's an historical plan, is the pension libre complémentaire pour indépendants, PLCI in French, or VAPZ in Dutch, and that's branch 21. So if you want to invest in stocks, that's not a good pension plan, because all you can get is just a guaranteed return that is below 0.5% today. More recently, for self-employed, they have developed, they came with a new product that is called CPTI in French, or POS in Flemish, and there you have flexibility in terms of investment. It's the tax deduction is not as big as for PLC VAPZ, but still you can deduct up to 30% of the amount you invest, and typically somebody who is as an average, meaning is getting a salary of about 50,000 euros, you can save up to 6,000 euros, 6,500 euros in that sort of plan every year. If you are closer to retirement, it's even more than that. That's for self-employed people, and the CPTI is basically, you have also an option for branch 21, but what we offer at Easyvest is that we wrapped the world tracker within that product. So you can basically have a similar portfolio as what you would get on an investment account, where you would replace actually bonds by branch 21. That would be your safe assets. Mm-hmm. And the risky part would still be the same tracker as what we offer in our investment accounts. But compared to the investment accounts, you get upfront a tax deduction of 30%.
So this tax deduction, how does it work? Because I'm not self-employed, but just to clarify for me. So 30% of what? of is it 30% of the amount that you invest, or 30%
Yeah,
of
30% of the amount you invest every year
yeah. So that's
is
tax you don't
being
have to
deducted.
pay.
Yeah, exactly.
Okay.
So if you invest 10,000 euros, you will have a tax deduction of 3,000 euros at the end of the year.
Okay.
Which will boost your return actually.
Yes, from that perspective, it can be counted as
because you would have only, if you had to invest that amount, you would only have invested 70% of that amount on an investment account, because all the rest would have gone to taxes. So it's kind of boosting your return. There are taxes, exit taxes at the end, about 10% when you reach 67. That's one negative point, and the second negative point is that it's blocked until you are it's blocked until you are 67. So you cannot get that money out except from one thing. It's a real estate project. So many self-employed people use that as well to actually save money and then invest that money into the acquisition of an apartment, or the renovation of their house or apartment. And you can do that for any real estate project. So it can be for you, it can be for a place that you want to rent, or it can be also for a second residence abroad. So it's
nice
very
retirement
broad.
plan.
Yeah, that's only for self-employed. And if you are company managers, I saw a question pop up. There you have access to something that is similar to CPTI POS. It's called AIP or IPT. And there it's just, it's the group insurance for company managers, and you can invest the same way as for the CPTI POS. And there it's actually your company that is paying an insurance premium for you as a director of the company, and it's 100% deductible. So depending on how much tax your company pays, you will be saving something between it's going to be a 30% income tax plus 20 or 25% income tax plus between 15 and 30% withholding tax. So you can actually save up to 55% by investing in that product. And again, you get the same investment portfolio as with Easyvest, investing in the same tracker, and you can use that money for real estate projects. But it's blocked until you are 67. So it's a long-term game. So what we advise people who want to stop early is that they should build an investment portfolio and a pension product on the side. They should live from their investment portfolio until they reach the legal retirement age, and then afterwards they can use the money they've saved in their pension plan. It's going to remain invested, and they will use it just later. And they just should see that as their whole wealth, or they can use that money to invest in an apartment that they can rent out, and they can get the rent to pay to get an income. So those are the two options for those who want to stop earlier.
Yes, early retirees. Okay, but then what about the fee structure? Is it similar to a regular investment plan with Easyvest, or?
Right now, well, the insurance world is a bit different. Usually it's very expensive. So that's also why we started in the insurance world. We were saying what we were charging for investment accounts, and we saw what they were charging for insurance products, and we were really frustrated. Well, that was one frustration. The second one is that everybody in the industry was offering only mostly branch 21 products, and that made no sense for us as financial managers. That was already a couple of years ago, underperforming, not beating the inflation or not covering the inflation. So it wasn't financial nonsense. So high costs and low performance brought us to that segment of the market. We wanted actually to offer trackers. We are still the only one to offer a solution with trackers in the insurance world, and we wanted to lower the cost. But we still have to collaborate with an insurance company, and they still have to get fees. So the most we could do is recurring fee of 1.5%. That's what's charged. And there is an entry fee of 1%, and Easyvest doesn't get a penny of that entry fee. It's actually charged by the insurer. So we tried to negotiate the best conditions for our investors, but still it's more expensive than for an investment account. But the tax advantage is there to actually cover part of those costs.
Mm-hmm. And so this insurance component does not, on the entire portfolio, say on a CPTI, that would be just for branch 21, the part of the bonds. Is that where the insurance takes place, or does it have to be like the whole portfolio in that plan, so the whole plan?
It's basically the fact that an insurance company wraps a portfolio within kind of an insurance wrapper gives you a tax advantage. Without that, you don't have any tax advantage.
So there's a tax advantage, and then there's this ongoing fee by the insurance plus the entry fee, right? Which is sort of what they charge anyway. But what you do is, instead of that money being invested in the regular actively managed funds or other funds, you use a very simple approach of trackers, which makes it basically more, highest performance, which improves the quality of the product overall, compared to all the other ones, which will most likely be underperforming massively just because of that change. Is there then a difference in costs between, say, yours and so what are the key differences between what you offer and what traditional banks would offer? Is it only that change from, say, actively managed funds to trackers, or is there some other place where you make a difference?
Well, as I say, if you go, if you go to BNP, to name some companies,
I can erase the name.
If you go to every single bank works with a single insurer. They are just actually broker of the insurer. There are banks and they act as brokers. And most of them will charge between 5 and 7% entry fee. So if you pay 100 euros, they will take 7 euros, and only 93% would be invested in the product. Some of the insurance company they work with only offer branch 21. So with some banks, you will not ever been offered to invest in branch 23. So all you get is a guaranteed return of between 0 and 0.5%. So that's the second differentiator. We have low entry fees, and we promote actively branch 23 because in those products it makes a lot of sense. You cannot take full. You can not act fully because the money is blocked, and your investment horizon is very long. And then the third differentiator is that we actually, there is a cost of 1.5, and then it's invested in trackers. Mm-hmm. With other insurers, they will charge you. You will sometimes feel that they charge less than Easyvest because they will tell you that they charge 1%, but then they invest. That's actually the cost of the insurance wrapper, and then behind they will invest in the highest charging share class of actively managed funds. Why? Because they have to pay their network of brokers, and so they charge. Most of them charge between 3 and 3.5% total recurring fee. If you add the wrapper to the cost of the actively managed funds, so you pay much less with Easyvest. You have access to performance financial products, and you reduce recurring costs massively.
Yeah, and so those other banks will typically then go with those plans that invest in actively managed funds, whereas in this case you have an agreement with the insurance provider that they will invest in your funds, which is where you charge the 1%, right? And so the fund management fees on your side would be far less, and it would be just trackers, and you've negotiated lower fees, entry fees, and yeah, I see. So is that a good summary of the structure? I'm trying to see how that works for you too, because we have to make money somewhere, right?
Well, we still make money. I mean, like, we are charging way less for our investment portfolio, and it's profitable. So we just have to have larger volume, actually, and
Yeah.
lower cost structures, and that's our job. So promote our products and make sure that we can operate with the lowest cost structure as possible. Yeah, so that's basically no entry or very little entry fees, great financial products, and very low recurring fees compared to competition.
Yeah, yeah. And so for self-employed people, you would recommend going for CPTI instead
Yes.
of PLCI, which is the branch 21, right? That's my
Yeah.
understanding. And then for company managers, then there is the EIP, where the
Yes.
company pays them a pension that has a high tax deductions. So that seems to be a simple advice, right? And so here, the main, like, what's the advantage for someone in that position? Say there's a freelancer or self-employed, and he hears about these products, and they also know that you have a traditional investment plan. The traditional Easyvest portfolio. Like, in which case should they go for one, and in which case should they go for the other one, and in which case should they go for both? Like, how do people decide which one to go for?
As I said, you should go for both. First, if there is a limit to what you can put in those tax deductible products. So if you save a lot every year, at some point the tax deductible product will be full, and you will have to find another way to invest. So you'll have to invest in investment products. To my mind, you should, and that's one thing. You should always favor tax deductible products if you're above 40. Below that, it's fairly it can depend, but the closer you are to retirement, the higher the impact of the tax advantage on the total return of your investment. So if you are very close to retirement, you should for sure put a lot of money into those products. If you are 27 and if you have a 40 years investment horizon, it's still going to be interesting to have one of those products, but it's not going to be as interesting as when you are 67, because the impact of the tax advantage will be spread over a longer period of time, and since you have a higher cost structure, well, the tax advantage will compensate, but it's not going to be as if you were paying at 65 2 years before retirement, where actually the tax advantage will be like 25% on a yearly basis. So there you can choose between the two. If you don't want your money to be blocked in a product over a long period, it maybe not be a good product for you. But if you want to do some real estate projects, this is a great way to do so, actually, because you can quickly take the money out and invest in a real estate project. So, for instance, last year at the end of the year, we had somebody who could actually put up to 70,000 euros into an EIP, and on December 1st, he invested that money through his company, paying no taxes, and 15 days later, the money was back on his bank account, not the bank account of the company, to renovate his house. So he got 70% of the amount instead of probably 50. And there is still some money that is blocked, partly to pay the taxes at the end, but still 30% of the amount is blocked in the plan for later. So that was a good deal for him. So if you want to do some real estate project, you should for sure consider also those products.
Very interesting. Yeah, that's an interesting trick and definitely a smart way of using those plans. But yes, so thanks for this comparison. Do you have a blog post or some analysis or some tools to help people decide, or sort of, I'm guessing you've modeled this. I'm interested in seeing that as well. And then if you have that, maybe we'll link that into the description as well of this video once it's recorded.
We have one blog post, our last blog post on pension planning, but it's not specific to those products. We will do more in the over the end of the year, because actually pension products are seasonal. You invest all year round, but you think about tax deduction only at the end of the year. So it's now that people who are self-employed or who have a management company are thinking about the ways to lower their taxes. And so right now we will publish more on that topic, and we will try to promote branch 23 and all those products.
Cool. Well, let me know when that's coming, because I'm interested, and I think I'll share with the community as well.
Okay.
Cool. So like, we've covered a lot of ground already, and I have a few more questions related to how you run the business and how you guys are doing this, because I'm very interested in how that is even possible, because I can imagine the challenges. But I thought we would open the floor to questions from the audience, because we've talked about the different kinds of offering you have. And so this is a good time, I think, for people who might be interested, or, who are, curious about how what you offer, to just turn the camera on and their microphones on. So everyone in the audience, guys, feel free to turn on your camera and your microphone. This is a good time to ask questions. We will have another session for questions at the very end, but I would recommend we ask, all of the investing questions now. Yeah. And if there's no questions, I'll continue. But so either you type in the chat, or you let us know. I see that someone is typing lots of questions in the chat. So Thomas and Fitri, would you like to come on with your microphone and maybe ask your questions live? That'd be easier also for people that are in the recording. I mean, for people who are watching the recording. Yeah.
Hi, Corentin. Thank you.
Hi.
This is not relevant to the pension, but the investment part. So if you are with Easyvest, is there any minimum duration to stay? I mean, how long the money needs to be blocked there?
It's never blocked, so you can buy one day and sell the next. Well, it's not our investment approach. And if you do that a few times, we will just say, well, I think that you missed the point with Easyvest. But if you invest now and then in a few months you realize that you need to buy a real estate property and you want to get your money back, you just give us a call and the money is back on your account within 3 days and there are no costs.
No cost. Okay, good to know. At one point you said that the fees are 1%. Is it per frequency or per transaction?
It's recurring, and that's 1% below 25,000 euros. But if you are between 25 and 50, it's already 0.9. Between 50 and 100, it's 0.75, and it decreases. It includes everything. It's a recurring fee, and there is no other cost. Except from financial taxes. I see that in your list of questions you mentioned the transaction tax. Here it's on the trackers. Here it's 0.12%. You still have to pay that tax. That's not included in our tariffs, just because it changes every other year. it's not really possible for us to include that in the tariffs.
And it's reported directly by Easyvest, or I need to do it myself?
No, everything is withheld, so you don't have to declare anything at the end of the year. In the Belgian declaration, they will ask you 2 questions about investment accounts. First, they will ask you, this year they were asking you if you had many different investment accounts because of that was to track the tax on investment accounts that doesn't exist anymore today. And the second question is, do you have investment accounts abroad? Because there nothing is withheld, so they want to check that you actually declared the account and also declared any revenue or transaction, because you have to pay taxes in Belgium for that. But if you have a Belgian investment account, you don't have anything to do with your declaration.
I see. Okay. And maybe I misunderstood. You also mentioned that there is no tax on capital gain. I don't really understand that.
Well, yeah, if you buy a stock and if you make 100% on that stock and you sell it, there is no tax. So it's the profit is all for you.
It's not the 33%. Maybe I read it wrong somewhere.
No.
No.
That's probably the withholding tax on the gain that you would make on a bond on a fund that is investing in bonds. If you invest in stocks, there is no capital gain tax. But if you invest in a portfolio of bonds through a fund, normally you should pay a tax on the interest that you get. And they assume that the capital gain you made on the bonds funds is just the sum of all the interest you should have paid tax on, and so they tax the gain you made. But that's the only sort of capital gain tax that exists in Belgium, which is not called capital gain tax, it's called a withholding tax on the proceeds of the sale.
Okay, thank you.
You're welcome.
That's why Belgium is awesome.
Let's hope it remains awesome.
Yeah, it might change. Thanks for your question, Fitri. Very interesting. I'm glad you clarified these points because they're very important. Thomas, you had also some questions. Would you like to ask them?
Yes, hello. I'm a young self-employed, below 30 years. And I was wondering, EPT and VPZ, are they interesting since they have a high entry fee and high management fees?
Well, as I said, with Easyvest, you have low entry fees, so it's only 1%. And we don't really recommend VPZ, we recommend EPT more. If you talk to a regular broker and if you talk to your accountant, they will always tell you to favor VPZ because they look at the tax advantage mostly, and they don't look at those products as a financial investment. But if you look at the total return over the lifetime of the investment, VPZ doesn't make sense, even though you will save more or deduct more this year. But with an EPT, you have the possibility to invest in the tracker that we recommend, so the World Tracker, and so you get the best of the two worlds. So you get the tax deduction and you get the great investment. It's true that the fee structure is a bit higher, but still it's covered by the covered by the tax advantage, and you have the possibility to take that money out at some point to make a real estate investment and benefit from it. That can happen. I mean, I will just give you my example. I was not planning on using the money that was in my EPT. It was there to stay for a long period of time, but I'm just in the process of buying a house, and I realized that renovation costs a lot. So I will make use of that money to invest in real estate, and actually, it's going to be a great thing because I didn't pay tax or much tax on the investment I made in the EPT. It was fully deducted in my company, and now I can use it.
Okay, thank you.
Good question, Thomas. Thanks for that. Anyone else? More questions? Now is the time, and then I'll give you 10 seconds to decide. And if you don't have a question, then I have more questions for Corentin, and then we'll do some more questions in 20 minutes when we get to the end of the event. Cool. So no one, no regret. You have one last chance in 20 minutes. So Corentin, I have a few more questions which are related more to how you run Easyvest. Wait, how come? I just want to. Yeah. Anyway. Okay. Yeah. I don't know why. So Thomas, is your microphone still on? I'm trying to understand why. No, it's off. Yeah. No problem. So what are your biggest challenges as owner of an automated investment platform that is disrupting the industry? We're very interested to hear that part.
Well, the two things is just like trust first. People don't trust. The main asset of a financial institution is trust, and as a newcomer, people don't know anything about Easyvest. Now we see that we're gaining some traction because people, after a few years, have heard about us like a few years ago and see that we're still there. So they kind of trust us more. But that's our biggest problem with our clients. And second is awareness. I would say brand awareness first, but that's linked to trust, but also awareness about investment and index investing in Europe and Belgium. So people in Belgium are not really, I would not say that they're not financially educated, but it's not like in the Anglo-Saxon world or in Germany where people just, they know that it's something that they should tackle, that's a big issue they should work on. They get information and they make sure that they do it right. Here people just don't really care about it, and they would rather give their money to a manager that would do that for them. So and they don't know anything about index investing, and they don't really know or understand that it's performing much better than active management. So yeah, it's awareness about financial investing and trust. Those are the two biggest hurdles for Easyvest.
So this is in terms of convincing clients that you're a trustworthy party, then your investing strategy is worth considering. Are there challenges when it comes to relationship with bigger players? I mean, you're obviously bringing in knowledge and a service in an area that is been proven by academic studies for decades is more performant than what the traditional financial sector is offering, and obviously you're cutting costs, right? And so have you had any experiences and comments? I don't know, are the challenges related to the fact that you're basically disrupting the business for these bigger institutions, or maybe you haven't reached that size to be noticed yet? I don't know where you stand there, but do you have any examples or stories around that?
Yeah, there is just, we haven't reached the size where they think that we are a threat, but it's going to be coming. I mean, like in the US now, people are investing more in index funds than in actively management, and you see outflows in one category going all the way to the other side. So that's something that is coming. But so far we there is we don't have any challenge with the biggest player. We thought that we would, but actually no.
Well, that's good news.
Yeah, actually, yeah.
Okay, let's keep it that way for a while until it's too late for them to just, once the wave is going and you're surfing the wave, then they can't do anything about it. So what do you think it would take to change that in just Belgian culture, I guess, like education awareness, like how do we achieve this? How do we, because that's what I want to do, right? How do we make that happen? Like what do you think?
What you do is the right way. It's like you have to be a missioner. You have to go around the world with and talk to people and let them know. That's also something that we don't do. We don't talk about money in Belgium. Money is dirty, and people don't like to recommend a financial advisor. They fear that that financial advisor might not serve their friend well, and people don't want to it's and also as people don't talk about finance, there is no opportunity to share about index investing. So
first we need to talk about money.
People like you, yeah.
First, we need everyone to talk about money, and second, once they talk about money, they need to talk about the right way of investing.
Exactly.
So we have two challenges.
But even within Belgium, there is a kind of a border between the north and the south, because in the north of the country, in the Flemish region, it's not a problem if you boast because you have succeeded in your business, and it's not an issue to tell your friends that you have sold your company that much. You're kind of even proud about it. Whereas in the north, in the Latin part of the
south,
Belgium, the south, sorry, Latin part of the country and of Europe in general, you just don't show off too much. So you sold your company, but you don't tell anybody how much, and you don't tell anybody about the way you actually have invested your money. So people don't talk about that and don't talk about financial investing. So if you want to change that, you have to go and take part to webinars like tonight, or organize webinars like tonight, publish content, make sure that your clients talk about you and your investment approach to other people, and that's the way it works.
All right. Well, we have a mission. Everyone who's watching this, I hope you're joining the mission. We need to change this because it can change people's lives. It's changed my life. And so my mission is to help other people benefit from this too. And I mean, with the work that you guys are doing is amazing. We need more of you guys. We need you guys to succeed. We need big banks to notice you at some point, but too late. So let's keep it that way. I hope they don't watch this video. maybe they should, and then they learn anyway. All right, some other questions if we still have time. Yes, we still have time. What are your biggest challenges when it comes to clients and client management? Just in general, like we talked about the industry, now let's talk about clients.
Client management, we have to manage. There is some kind of that's operational, but there is more and more regulation, financial regulation, and that's a big burden both for the clients and for us. And you have to maintain that compliance all the time. So it's not just something that you do once; you have to do that regularly. But thanks God, we are a digital company, so we can automate a lot of things. And the challenge that is more specific to clients is just to educate them to make sure that they don't panic when the market drops. And this year was a big test for our community of investors. And I was very proud of my community because nobody, except from one person, nobody really panicked. Nobody sold. A lot of people actually invested more. Because I believe because we have that small human interaction at the beginning of our investment process, where we don't talk about performance, we talk about risk, and we tell people, at some point over the next 10 years, or 3 years actually, your portfolio will drop with 20 or 30% depending on your risk profile, and that will be normal, and you should not be panicking, and actually you should invest more. And we ask those questions. We talk a lot about risk more than performance to make sure that they don't panic. And as I said, this year the drop was significant and very quick, and everybody behaves correctly. So managing emotions is something that is a big challenge, and the only way to approach that challenge well is by managing it from the start.
Okay. And so do you do something on a regular basis with your clients, or is it really just that initial conversation that sets the tone and then hopefully remember what you said? Like,
Well, we are available to answer questions at any point. Actually, we have a touch point with our clients every time they invest more money, when they add money. So far, it cannot be done automatically. So we always have to validate the fact that we invest the money and that we invest it according to a certain risk profile. And it's always an opportunity for the client to ask questions. But if there is no rebalancing needed, if the portfolio is well balanced, apart from the blogs that we send and the status, there is no proactive interaction.
well, that means it's not necessary. So you've done a good job already. I mean, this is what you just said about what happened in March. So it's effective. That's good. Cool. I'm glad to hear that. And I think in general, in the financial independence community, people have been pretty good as well. There are a few people who panicked and sold. But then, yeah, most of them actually didn't make it work properly. So it sold at the worst time and then didn't come back in. So how do you, I mean, from what I hear, then you don't really have clients who are trying to time the markets, or do you?
We do have clients that try to time them, or that would like to time the market, but most of the time we tell them not to. And but as I said, I'm not managing the portfolio of my clients, or actually they always have the last word. So some people do. It can happen. If we did not manage to convince them that it was a bad idea, we can accept that some people do that one or two times. But if they do that too regularly, we say we're just not the right financial institution for you. You should go to a trading platform. And actually, it goes so much against our investment philosophy that we don't really want to handle that.
Yeah, because we know it's harmful, right? So
exactly, and actually the regulation imposes to have a coherent speech to all our clients. So we cannot tell one client who wants to actively trade, yeah, you should be actively trading this way, and to the rest of the community, no, actually there is nothing to do. It's like somebody could question the fact that we give an opposite advice to one client and then what we give to all the others. Why, if it works, why did you give that guy an advantage? And if it doesn't work, why did you change your speech?
Interesting. I didn't know there was such regulation, and I think that's in your favor as well. No, that's very good.
We have to be coherent with
that's interesting. There's extra protection for the investor by the regulator.
Yeah, but when somebody wants to actively trade, it hurts. I feel bad, and I prefer not to be involved in that.
Have you had a case where people just who wanted to time the market, somehow they got the education and realized that it was a bad idea, and sort of bought into the full buy and hold index investing approach? Or
some people who really like to trade, you see that they have a profile of gamblers for most of the time. They do that on the side. They regularly question our approach, saying, yeah, but shouldn't we try to time the market, and we have to repeat our speech. But they still trade on the side. Okay. And actually, all humans are gamblers, so we don't say that you should not do it with Easyvest. We understand that some people want to do it, but we also say that people should never do it with their whole wealth, and that at least for 80% of their wealth, they should invest as we do. If they want to bet some part of their wealth on Tesla or other stuff, they should just do it with 20% of what they have, and the rest should be invested in a stable portfolio of index funds.
Perfect. Thank you. A few more questions, and then we'll have last 10 minutes for another Q&A if people want to join for that. Where do you how is it structured, Easyvest? Where are the assets? Like, what's your role? Where does the money go, and like where is it held at the end? Like, what are the different stages in the chain?
Okay,
so if there's a chain, I don't even know.
Basically, it's all really regulated, and you have different players at different levels. Easvest is an agent. We are in the process of becoming an asset manager, but right now what we do is we give specific advice that have to be validated originally by the broker we work with. So we are an agent of a broker company, Beursgenootschap, or Société de Bourse in French, and that company is Le Associated Brokers. That's the depository. So that's where your assets are held, at least the securities. So Easyvest is never holding your assets. They're never on any account of Easyvest. They are on a segregated account with Le Associated Brokers. The cash is not is there virtually there on your account at Lele, but effectively it's not at Lele, it's at a bank, because Lele is not a bank, and to hold cash you have to be a bank. So the bank is either with another commercial bank, and they work with 20 different banks to spread the risk. They work a lot with Belgium and ING, but basically with all the big Belgian banks. But currently, because of the uncertainty with the coronavirus, everything is held by the Belgian National Bank. So it's your cash is overnight at least held there, and your securities are held by Lele, but ultimately they are held by Clearstream, which is also a bank, and the function of Clearstream is to hold the assets of depositories. So that's the chain. So Easvest is there as an advisor, we provide digital tools. We promote an investment approach. We provide the infrastructure. We made the analysis to give good advices that have been validated by the broker, but your assets are never with us.
Yeah, and I think that's an important clarification, because obviously you are a young company, and as you said, still gaining trust, and you have to rely on like established players with a lot of layers of security, which cost a lot to establish and maintain. And so we always want the money to be away from the entity with which we are dealing, and hopefully with an entity that's sort of failure proof in a way, so that the assets don't go when, say, Easyvest or Lele goes bankrupt. Assets are away somewhere else, and they're held in our name, but in sort of in safe places, right?
Right. That's all. So we cannot do anything on your account without your instructions so far. When you're an asset manager, then it's going to be a bit different. You can give us a mandate, and we just manage things for you,
and then send the regular updates.
So that will simplify the investment process, allow us to do it, to automate more. We have a lot of clients, more and more, that just transfer money every month, and for some of them we have to call them every month. So it's kind of sometimes a bit painful. It's all fun or funny, but we hope that shortly this will be different, and the money will be managed easy, which will actually give us more time to focus on real support and not operation.
And not on the phone calls to confirm the operations, which I can imagine takes time. So what does Easvest look like in the inside? And the questions here I have is more like, how many are you guys? Is it just you and your partner, or you have more staff? What does a day in your life look like in terms of what you do? Like operationally, what does it look like?
Excuse me, I was reading a question which you told me I should never do. But,
yeah, that's why I turned off the chat. I tried to turn off the chat. So what does Easyvest look like operationally in terms of the number of people, and then what you guys do on a day-to-day basis, and you in particular?
We're 6 people. Some people work on. I'm managing all the clients. We have got one guy doing taking care of the digital marketing. We have one IT guy building the infrastructure and the apps and everything. We have a CEO that goes around do a bit of everything, and we have also 2 board members. Yeah, and one compliance officer that is helping us with the becoming an asset manager. So basically, that's the structure. Having a lot of people in our structure is not really an achievement for us. What we want is to have a broad base of clients, and that's the most important for us. Actually, if we can serve 100,000 clients with 6 people, we would be very happy, and that would be the biggest success for us.
Yeah, because employing more people is not exactly where this type of business is going, right? The key is to automate, to scale up,
exactly,
and sort of lower costs so they can capture more clients and basically help more people in a more effective way. So, yeah, I totally agree. Great that this is your vision as well, which makes good sense. And last question before we go. Actually, no, 2 more questions. Before we go to the questions from the audience, one is obviously your business, relies on volume, right? So you need to touch a lot of people, and you need them to invest enough money. Although you have a sort of scaled down type of fee. So how was that when you first started? How soon? Have you reached that point where you're basically profitable? And then if you have, how long did it take to get there? And how was that in terms of actually achieving this? I don't know if you're even there. Sorry, my question is really jumbled all around, but basically, are you profitable, and what kind of volume does that require? I guess that's a much easier way to ask the question.
Yeah, we are profitable we have been profitable for a couple of years now. But the thing is, every time you want to scale, so every time you reach that point, you find ways to spend more money so that you will expand. So but we have reached that point. We started with 2 people and not paying us any salary, and we didn't have much money we were saving every penny. And the first year was tough because nobody knew about us, and we had to promote our product. And we thought at some point that because we had a website and we had a great investment solution, everybody would be coming to us. But that's not the way it works. So we had to promote our solution, talk about index investing. It took 3 years to achieve profitability, and also we got some support from awards that we won from the Brussels regions for innovation, and they gave us financial resources to pay actually digital people who would help us digitalize our service. So we had external also sources of financing.
Okay, well, it's good to hear you're profitable, and that's basically this is a solid foundation for more. So I hope you make a lot of money and you can expand fast and help more people. So my last question is, where do you see Easyvest in the future? And so what are your ambitions, say 5-10 years down the road?
Well, we want to continue with our investment accounts because we believe that we offer something that is really a service that is outstanding for the fees you pay. If you want to have some service, there is no competition compared to Easyvest, and we have been over and over again delivering the best performance in Belgium compared to our competition over the long term. It's true that for every given year, there is always, or sometimes at least, somebody who has been doing a bit better than us on a certain risk profile. But overall, over the long term, we always deliver the best performance, and that's purely mathematical. If nobody can beat the market, the one that will bring the best performance is the one that charges the lowest fee. Where we see each other, Easyvest in a few years, is we have only started with pension funds, and pension is also a topic that is becoming bigger and bigger, because I'm not sure Belgium will be able to pay the current level of legal pension for very long. So I'm not certain that I will get the money they promise. So people are getting conscious about that, and also, yeah, the government is getting conscious about it. So they more and more promote pension solutions, and there is actually nothing good on the market at this stage. Everything is expensive and poorly allocated. So we want to expand broadly there, because there is so much to be done. So we will be working a lot on pension and pension products in the future, and we will be also keeping on working with our investment product, because I believe that we have something really good for everyone.
Well, I'm looking forward to all that, because I think that will be very useful. A lot of people here. So yeah, thanks again for taking time to answer my questions. Let's open the floor to questions from the audience. I see that Benoit and Fitri had more questions. So guys, feel free to come online and.
Hi.
Hi.
It's me again. I had a question I forgot to ask earlier. So I just remember last year when I have some free cash every month, I came to my bank and to ask investment account, and I specifically asked, do you have ETF? And then he said, no, ETF is not, will not give you good performance, blah, blah, blah. And then he sold me other stuffs. And he knows very well that I'm not young, I'm not a risk taker, but so he said that ETF is not the products that they have or they will offer to me. And the second question is exactly the same as Benoit.
Okay. So I think he gave you a wrong advice. The only thing is that he's not allowed to sell you ETFs, because he doesn't make any penny on it. He's making money on the entry fees, and he's making money on getting a portion of the recurring fee. So he has absolutely no interest in selling you ETFs unless he has a management mandate on your portfolio, and he gets a recurring fee anyway. So if you have a managed portfolio, you might find ETFs in your portfolio, but if you go to a bank who is selling funds, they will never give you an ETF. That's for sure. But telling you that it's not appropriate is a lie. It's just he's not allowed to sell you those products.
So the problem is, when we go to banks and to many institutions, really, we don't get independent, non-biased advice. We get advice from people who are representative of the company and have their company's interests in mind, right? So this is something tricky in Belgium. Is independent financial advisors are rare, and banks are definitely the last place you want to go to for independent financial advice, unfortunately.
And what is really disturbing is that actually some of those banks actually have a branch that is managing ETFs. So they are managing ETFs. Easy ETFs is a branch of BNP Paribas. Lixor is a branch of Société Générale in France. DB Trackers is a branch of Deutsche Bank. They're less well known as the Vanguard, BlackRock, and so on. But all the big European banks have a branch that actually manage trackers. So they have those products, but they just don't sell them through some channels. And the branch is one of those channels where you will never get an ETF.
Okay.
Interesting.
Interesting indeed.
Yeah.
Yeah, because of that, then I was thinking maybe I will just manage ETF myself. So exactly the same question as Benoit now.
Yeah, I think that's a good
Thanks.
question, and it's maybe something that Corentin, I don't know if you've seen the question. This is from Benoit
Yes.
and Fitri asking, why would you recommend to do ETF investment with Easyvest instead of do by myself with any broker? And that might be a question really, target to. I think it's a question to me because I might have clarified this, and I'll let you respond as well after me, Corentin, if that's okay.
Okay.
Yeah. So yes, I do. I do recommend for most people to learn the investment philosophy of index investing, and then see if they can invest on their own, and if they have the capabilities and the time to invest, to learn, and to do it well, then I think they should go for that. For everyone else, I think solutions such as Easyvest is the way to go. So that's my personal position on this. Also because it's part of the philosophy of financial independence, where costs matter, and so the costs of Easyvest will play a role. But I do realize that for the vast majority of people in Belgium, whatever I have learned and whatever I am teaching will be far beyond what they can handle in terms of managing portfolios and managing rebalancing and understanding their own risk asset, the risk profile, and setting up the asset allocation properly. And doing all that is not easy. And so for a lot of people, it's far easier to work with robo-advisors. So that's like the improvement of going from a traditional bank account, like savings account or even active fund, and moving to either index investing with Easyvest or DIY index investing. The improvement is massive, right? And so that's what matters to me most, rather than whether people are going to go with Easyvest or similar services, or if they're going to do DIY. The risk with DIY investing is that you might not be fully prepared and fully in control of the things that can happen to your portfolio, where you need someone like Corentin to say, hey, this is not the right time to sell. You've agreed this is a long-term thing, so I'm here to advise you not to do something based on a hunch that the market's going to go one way or the other, because we don't know. So there's a real value in the service provided here, so I think these are equally very suitable solutions, depending on the ability of the individual to do the work in one way or the other. And I can tell you from experience that a lot of people doing DIY index investing are doing it wrong. And it might cost them more than whatever is the fee that Easyvest will charge over a very long period of time. And you can even burn them, right? So it's a balancing act. Either you pay a little fee to get good advice and have someone watch over you because you might have emotions driving you, or you're very strong when you discipline your emotions and you do DIY and you save extra bit fee. But I would say there's a cost on both sides, right? And it's important to look at it like that.
Okay, I fully agree with what was just said. I mean, you can always buy water and flour and make your own pizza. So it's always possible to do that yourself. The ingredients are there. Well, one thing is it's important to select the right flour and even the right water. And it's the same with ETFs. I mean, like, there are thousands of ETFs, and it's not easy today to select the right products with the right tax deduction, tax structure, the right exposure, everything. That part is not difficult, but I'm sure you might find some information on blogs that could help us. But the trickiest part is actually remain rational whatever happens on the markets, and that's where you need a coach. And actually, for my portfolio, I'm very poor at doing that. I mean, like, when it comes to my own money, even though I'm managing the money of my clients in a very rational way, when it comes to managing my money, I become very irrational. And actually, I decided recently that my own accounts at Easvest would not be managed anymore by me, but by one of my colleagues who would make rational decisions for me. So even I, as a professional, know that the limitation of my investor psychology it's much easier to make the right decision for somebody else than to make the right decision for yourself. And as was mentioned by Sebastian, the cost of doing it wrong only once in a lifetime can be far more than the cost of what would cost Easyvest. If you just timed the market wrongly during the COVID and missed just a couple of trading days, you could be today 10% behind the benchmark or the index, and 10% is like 10 years. It's in compound return. It's gonna take you more than 10 years to catch up with that. And if you have done that once, you will probably do it again and again. And at some point, you will be lagging behind the index. Even worse, actually, you will, because you are lagging behind the index. You will take more risk than you should to catch up with the index in the future. So if you, as I said, your emotion is your worst enemy. Actually, you are your worst enemy, and that's the reason why you should have your money managed by somebody else. And if you are able to be rational, then DIY is something that that you can try, but most people can't.
Right. So I would say, when I think about this, I think there's a rule of thumb in my head. I have a rule of thumb. I'm thinking 10% people can handle DIY, 90% of people need help, because of the massive investment in terms of learning, and then the discipline and managing your emotions, being able to surround yourself with the right people and the right resources instead of being bombarded by all sorts of marketing, messages by banks and everything. But say, for example, you, Benoit, you've been in the community with us for a while. And so I think you start to see what it takes to do DIY. And then now I think with this presentation here, you've seen what it would be to work with Easyvest, for example. And so like, I think now you have a better information of what are the options. In the end, to me, what matters is that people start investing with index funds in the right way, right? Which is buy and hold, a balanced portfolio, low cost, globally diversified. That's my goal. And so if they choose to do the DIY route, which is the one I fully support because that's what I do, that's what I teach also, or not, in the end, the goal is there. And so I just want that to move. And I'd rather have, 100% of Belgians doing index investing and making Easyvest super successful than only 10% of Belgians doing DIY index investing and having 90% of Belgium, lagging behind by like crazy amounts and suffering every day because they just don't have the financial returns they're supposed to get. So that's my position. And so hence my interest in speaking with Corentin, also to learn from someone who's actually doing this on a daily basis, who has experience and I've learned that every single question I was asking today, I'm learning something. So I hope this helps the whole community as well. But yeah, I understand I think I should have clarified this a bit more earlier. It's just that I'm trying to get people to join. So I don't want to say, if you're doing DIY, don't join. I don't think that's right. Come listen and see what the options are and then decide for yourself. For me, 90% of people should do, work with an automated robo-advisor or investment platform like Easvest. So that's my current estimate. And I hope people hear this and actually do it.
Thank you.
Cool. Any more questions? It's gonna be time to go home soon because there's babies waiting.
Yeah.
Look, Corentin, thanks a lot for your time, and I think I think we're gonna close it here. The last question was really interesting, and the whole conversation here was fascinating. So thanks for that. Thanks for taking the time. As I said earlier, thanks for doing what you do and for having the courage to start this. Despite all the challenges. And thanks for living on a tiny budget for years so that you could make it work. And the community sort of tends to not value your services because everyone is hardcore DIY. But I'd like to bridge that gap because I think we have the same objective. And we are not completely selfish. We need to understand that robo-advisors and Easvest, you guys are here to make the life of millions of people better. and that the value that you provide is, high quality and it's high value. The service you provide is clearly worth the value that investors are paying for. So thanks for that.
You're welcome. But
hopefully we speak again soon when I have more detailed questions, and maybe I'll bring you on in a few years when you've overtaken the whole Belgium.
Okay, thank you. And as I said, you should, all of you, if you are there, it's because you like talking about finance. So go out there and talk about index investing. And for those who cannot handle DIY in your circle of friends, talk about solutions like us that can help them step in and become financially independent. So you all have a big role in promoting financial independence and index investing. So I hope that you play your part as well. I wish you a very good evening. And if you have questions, so feel free to just go on our website and ask me additional questions. I would be very happy to help you.
So easyvest.be, that is your website. Is that the best way to reach out to you? You have your email address available there?
Yeah, there is a chat. So you just leave a question on the chat with your email address, and you can ask me to call you back, or I will reply to your email if it's a short question. Yeah, so that's the best way to reach us.
Brilliant. Well, thank you for that, Corentin. I will post all the links of this conversation in the description, and hopefully you get business from this, and hopefully you'll help more people put their finances in the right place, because that's what we do. Thanks everyone for joining. Please take control of your finances so they can live more and give more and be happy and help people around you. This is what Easyvest is doing. This is what I am doing, and I hope you will help us with that as well. So I think with this, we're gonna close the event. Right, so that was an amazing interview. Thanks for watching. I hope you really enjoyed, and I hope you learned a lot of things like I did. As always, be sure to like and subscribe, and join the community on Facebook. Join the mailing list to be kept in the loop about future events. You can join these events, you can ask your questions, and we actually meet up on a weekly basis to talk about personal finance, investing, and financial independence. So be sure to check the Facebook group, the website, the mailing list, and I'll see you soon here again. Take care. Goodbye.